Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. In the previous 4 parts, we covered what scalping is, the key aspects of market structure that need to be considered, and a few indicators that can help track how that market structure evolves through the day, while also identifying short-term trends. Today, we move to the doing, that is, how to select option strikes, the specific setups to trade on a given day, and lastly, how to use the indicators discussed in the previous video to define trade entries and exits. So without further ado, let's get started. Disclaimers first. The ideas and examples shared in this episode are strictly for educational and illustrative purposes only. Nothing discussed here should be construed as a recommendation, investment advice, or a solicitation to trade. Trading in derivatives involves significant risk and can result in complete loss of capital. The examples and data presented here are meant to explain market behavior and not to suggest that similar outcomes will occur in the future. Outside of the risk disclaimers, note that I would be using third-party tools like TradingView Premium to demonstrate the custom indicators that we would be referring to in this video. Also, a basic understanding of options and derivatives is assumed to fully understand the concepts discussed in this episode. With the disclaimers out of the way, let's get started. In episode 1, we discussed why scalping should ideally be done in products with lowest possible transaction costs, and in that context, weekly Nifty options stood out as one of the more efficient choices. Yes, transaction costs in Nifty options have gone up over the years, but they still remain relatively low for scalpers. I also covered the break-even cost of trading Nifty options in that episode, so you may want to revisit it if you have not already. That brings us to the next practical question: strike selection. As a scalper, this is a decision you need to make every day before the market begins and perhaps before every trade. That is, which option to trade, call or put, and which strike to choose. Before getting into that, remember one important distinction from episode 1. You can scalp either as an option buyer or as an option seller. While the strike selection logic may not always change drastically, the way trends play out and the way price behaves can feel quite different for the two. My suggestion is simple: try both and see which one suits your temperament better. When it comes to strike selection, my approach is to keep it simple and safe. Simple because this is a daily decision and it would eventually become intuitive. Safe because the risks faced by an option buyer and an option seller are very different, and your strike selection framework must respect that. It may not be the most precise method from a Greek standpoint, but it is practical, repeatable, and in my view, safer. After thinking about this problem for a long time, I have arrived at a very simple thumb rule. Whether you are a buyer or a seller, if you want to keep things straightforward, trade one in-the-money strike or one ITM strike. Meaning, if Nifty spot is at 23,200 at open, check where synthetic futures is at that time. You will be able to find synthetic futures on Sensible. Now, you may see that synthetic futures is at say 23,300. In which case, select an in-the-money strike of 23,200 for call and 23,400 for put. For better liquidity, stick with strikes with round numbers. Now, this approach to selecting a strike for a buyer gives you useful delta while reducing the impact of theta decay. For a seller, it gives you delta exposure along with a modest theta advantage. It is not the most sophisticated framework, but it is simple, robust, and easy to apply consistently. One additional point: on 1DT, especially if you are a buyer, it makes sense to shift to the next week's expiry. On 0DT, whether you are a buyer or a seller, it is generally better to trade the one ITM strike of the next week's series rather than the expiring one. Also, as shared earlier, when deciding, in the money or out of money, make sure you are basing that on synthetic futures and not on spot. If you're new to the concept of synthetic futures, check out this short. So with strike selection out of the way, let's move to entries and exits. Before we do that, I want to point out that there are broadly two styles of scalping. The first is to identify the start of a micro trend and assume that the move is likely to continue for the next 30 to 50 minutes. In that style, you keep scalping in and out of the same trend. For example, if you are targeting 3 or 5 points, you enter, place your exit at the target, and each time the price pulls back by 2 or 3 points, you re-enter and look for another 3 to 4 point move. This process is repeated multiple times within the same trend. Traders who follow this style often do not keep a hard stop loss for each trade. Instead, if the move begins to go meaningfully against them, say by 10 points or so, they exit, step back, and reassess the setup. The second approach, which is also my preferred one, is to identify a micro trend, define the trade clearly, fix a stop loss, and then let the trade run until either the price action or the indicators give you an exit. Instead of trying to capture 4 or 5 points over and over again, you try to ride the trend for as long as it remains valid. This approach usually leads to fewer trades, perhaps 4 or 5 trades in a day. But in my view, it is far more practical and sustainable over long periods of time. Scalping in and out of the same trend repeatedly may sometimes produce better returns, but it also demands far more effort, and to me, it's usually not worth it. So that brings us to the practical side of the discussion. How do we define our entry, and how do we decide the stop loss, and what are the signals we want to rely on for both entering and exiting a trade? First things first, make sure your screen setup is ready. You should have the Nifty spot chart open as your reference chart with all the indicators we discussed earlier visible on it. Alongside that, keep the in-the-money call and put options handy on a watch list. If you are using a scalper terminal or any trading terminal on Kite, make sure those strikes are already loaded and are easily accessible. You may also want to keep the chart of the specific strike you plan to scalp open with a simple indicator on it. My suggestion would be to use something straightforward like Super Trend with a 5-2 setting instead of the default 10-3 setting, and use that primarily as a trailing mechanism. You do not need to automate this, even manual trailing is perfectly fine. The key point is, before you take any trade, your screen setup should be ready and be in place so that you are not making operational decisions in the middle of a moving market. Also, make sure that all your charts are on the same time frame. Unless you are deliberately doing multi-time frame analysis, which is not something I would recommend here, there is no need to complicate things. A 3-minute chart is more than sufficient. Many scalpers use the 1-minute time frame, but if you are just starting out, it is better to begin a little slower. You are not necessarily giving up opportunities by doing that. In fact, for the approach I am discussing here, taking fewer trades but staying with them as long as the micro trend remains intact, the 3-minute chart works very well. It is a good balance and in many ways a sweet spot. So keep it simple, make sure your reference chart, which is the Nifty spot chart, as well as the call and the put option charts, are all set to the same 3-minute time frame. That way, everything you're looking at is aligned and you are not introducing unnecessary confusion into the decision-making process. And that brings us to the first trade opportunity of the day. On most days, you are likely to see this trade emerge somewhere between 9:30 and 9:45, and I am referring here to a breakout setup. On the spot chart, this could appear either as an upside breakout as shown in this example, or as a breakdown on the downside as you can see in this chart. Now, this timing is not fixed or guaranteed. There will be days when the move begins closer to 10 and others when it may appear only around 10:30. So do not treat the exact time as a rule. The broader point is that on most days, the first meaningful opportunity tends to show up within what I call the S1, the phase from 9:15 to 11:27. Somewhere within that window, you will usually see the day's first workable microtrend begin to take shape. Once that move starts, it generally has a certain shelf life. On the shorter side, it may last around 45 minutes, while on the stronger side, it can continue for 90 minutes or even longer. That is important to keep in mind because once a microtrend gets underway, the expectation should not be for it to end immediately. It usually has some room to play out. These are not hard rules, but they are useful tendencies to be aware of. And in many cases, this breakout becomes your first real trading opportunity for the day. Take this example from 25th of March. The breakout held on for close to 1.5 hours. While this is an extreme, but I'm sure you get the drift. Here's another example of a similar breakout. Now, obviously, the next question is what happens on days when things do not play out as cleanly? There are a few possibilities. First, the initial upside breakout or downside breakdown may turn out to be false, in which case it can take you out of the trade. Second, the market may reverse, after which you might either get a breakout in the opposite direction or another breakout attempt in the original direction. Third, you may simply get a choppy day where the price remains range bound throughout most or all of S1 and the real breakout only comes later in S2 or even S3. Look at this chart from 19th of March. The price kept coiling till about 1 in the afternoon, and post that around 1:30 or 1:45 you get this breakout and a large part of the range was formed at this time. There would be such days, and it's good to kind of expect that, especially on days where the initial two segments have a coiling kind of price action. This is where tracking the range as a percentage of the average range becomes useful. For instance, if you're still in S1 and only about 30 to 40% of the day's average range has played out, it tells you that the possibility of a meaningful move later in the day is still open, particularly in S3 more than S2. In other words, just because the market has not moved cleanly early does not mean the opportunity is gone. That said, there will also be days when the market remains tightly coiled in a narrow range for almost the entire day. Those are often the best days for option sellers, and on such days, you may not get a clean scalp trade at all. Also, keep in mind that even if the microtrend lasts for an hour, the size of that move, the number of points it actually covers, will largely depend on the broader volatility regime in the market. In a low range environment, even a trend that persists can only travel so far. In a high range environment, the same 1 hour trend can cover substantially more ground. That is also why it helps you to anchor your expectations to the median or mean range observed over the recent past. Doesn't matter whether it is the last 5 days, 10 days, or even slightly longer historical window. Doing so gives you a more realistic sense of what the market is capable of on a given day, rather than expecting every trend to deliver the same kind of move irrespective of the broader market regime. The next logical question is, what do we do on days where one breakout fails or even two breakouts fail? In such cases, it is quite possible that the market is in a narrow range environment, or that the real trend, as we discussed earlier, is simply going to emerge later in the day. On those days, instead of relying only on breakout-based setup, this is where the breadth indicators we discussed can become useful. The same applies to price action and the EMA-based indicators we covered earlier. Now, you want to use these indicators for confirmation and then look for the next valid setup. The direction should not matter. You have to stay completely agnostic of it and respond to what the price is telling you. In fact, once a couple of breakout attempts have already failed, the odds of the next clean setup in fact increases post that. Here's one such day, 20th of March. As you can see, the first two upside breakout attempts failed, after which the market gave a downside breakdown. That breakdown did not extend much below the low of the day and was followed by a fairly meaningful pullback relative to the extent of the move. After that came another breakdown, and so on. Broadly speaking, this was a relatively low range day. These are the kind of days where, as I mentioned earlier, breadth indicators become especially useful as signals. If you notice, the red arrows at the top and the green arrow at the bottom mark the trend changes indicated by breadth. At the same time, the EMA-based stage indicator we discussed earlier also aligned clearly in our favor across the three micro trends that appeared during the day. Now, while saying all this, I should add that questions of maximum loss for the day, position sizing, and overall risk management are as important, and we will address them separately. But in this part of the discussion, my focus is not on that. Here, I'm only talking about the different types of setups that can emerge through the day and the points at which these micro trend opportunities are likely to appear. Okay, that reminds me of the second possible setup in S1 or S2. Now, this segment is relevant only for S1 and S2 segment, especially on days when you get a strong trend that lasts for close to an hour. After making a meaningful high, the market will often see a pullback of roughly 15 to 30% of the range. That pullback can be tracked using indicators such as distance from high or distance from low. From there, the market often attempts a retest of the high or low that was already made. Fair warning, do not enter the trade till the move in the trend direction starts. You will have to keep a trend reference for that. EMA-based indicators can be used here. Your target typically is the previous high or low, or you can also keep it trailing. Now remember, that retest can do one of the two things. It can lead to a further extension of the trend, or it can simply remain a retest, after which the price may begin to oscillate within a range for the next couple of hours. This is especially likely if a large portion of the day's range has already been covered in S1 itself. So this becomes another setup worth watching for, particularly on days when a significant trend has already unfolded in S1 or S2. This is one example from 25th of March. Again, take the example of 17th of March. In that case, the pullback was relatively deeper. But this is not a setup you want to keep trying multiple times. It tends to work best on the first pullback after the initial trend. After that, the reliability starts to fall. As you can see, on 17th of March, the first pullback was deep and it failed, and that happens too. Later in the day, the market did resume the uptrend, but the first pullback remains one of the cleaner and the more dependable setups. Now moving on, one question that always comes up is this: once S1 and S2 are done, should you even trade S3? My view is that S3 should be traded only when S1 and S2 have remained extremely narrow in range. On most other days, I would avoid it. The reason is simple. Once the market has already moved meaningfully in the first half of the day, the chances of false breakouts tend to increase, and you run the risk of giving back what you made earlier. This is important because as a scalper, one of the key objectives is not just to make money, but also to avoid overtrading and protecting what you have already made. Of course, there will be days where S1 and S2 work well and then S3 still delivers a strong trend. But that then becomes a matter of approach and temperament. But if you still decide to trade S3, then the better way is to trade it consistently rather than selectively, because excessive discretion usually creates more confusion than edge. Yes, that will also mean there will be days when you give back some of what you have made in S1 or S2, but over a large enough sample that may still work out. So this is as much a psychological choice as it is a statistical one. If your goal is to be more conservative, then a simple approach is to trade S3 only on days where S1 and S2 have been unusually narrow. If on the other hand, you want to include S3 as a part of your process, then do it systematically every day rather than only when it feels attractive. You can also manage this through position sizing. For example, if your morning size is X, you may choose to trade S3 with the same size or with a reduced or adjusted size depending on what helps you protect profits without becoming overly discretionary. Anyways, all the decisions apart, let's say you decide to trade S3. Then, broadly speaking, there are three kinds of setups that can show up in this segment, and we'll go through each of them. More importantly, we'll also discuss what exactly to look for on the chart in each case. So let's get started. The first is the classic range breakout. Here, the market has been trading within a well-defined high-low range through the day, and then in S3, the index finally breaks out of that range. This is the most simple and straightforward setup. On such days, it helps to keep an eye on previous day's high because a close above that level often signals greater strength. You should also watch for key reference points such as an all-time high, a major round number, or any other known resistance levels. If price manages to close above such levels, especially in S3, the chances of that move sustaining tend to improve. As you can see on the chart, 16th of March was one such day. The second setup is when price is trading around the TWAP, which is often close to the midpoint of the day's move. In this case, you may not necessarily get a breakout of day's high or low, but you can still get a meaningful expansion away from TWAP in one direction. That is another type of move worth tracking. The third setup is almost the opposite. If S1 and S2 have already seen a strong trend and price has moved significantly above or below TWAP and stayed extended, then S3 can become a window for mean reversion. In other words, instead of looking for continuation, you begin looking for a move from the day's high or low back to TWAP. If you look at the chart of 3rd of March, it is one such day where you can see both the second and the third setups I referred to. Now, with all the setups done, here are a few thoughts about trade execution. Given the liquidity in Nifty options, you can generally use market orders, and in my experience, even fairly large freeze size orders can be usually executed with limited slippage. The same cannot always be said for products like Sensex or Bank Nifty options, where you need to be much more careful. In those cases, once you identify your level on the chart, typically on the option chart itself, it is better to place a stop loss buy or stop loss sell order so that if price moves in your favor, you get triggered into the trade rather than chasing it manually. Beyond that, as we discussed earlier, you can use something like a super trend as a trailing mechanism once the trade is live. The other important point is strike selection during the day. At any given moment, you want to be trading what is roughly one strike in the money at that point of time. Do not get anchored to the strike you selected in the morning, because as the day evolves, price moves and the strike that was won in the money earlier may have become at the money or moved deeper in the money. So keep reassessing and choose strikes based on where the market is now, not where it was when the day began. If you're using a scalping terminal, keeping the option chain visible alongside you makes this much easier. And finally, if you miss a trade, let it go. Do not rush into the next one out of impatience. There will always be another day and another opportunity. So the key is to stay composed and avoid forcing trades. Talking about stop losses, the moment your trade is in and it's active, the first thing you should do is identify where your trailing level lies, whether that is based on super trend, a moving average, a percentage based trail, or any other system you are using. Once that level is clear, make sure the stop loss is actually placed in the system. Do not rely on a mental stop loss, which many traders tend to do and which I strongly discourage. If the stop is important enough to define the trade, it is important enough to be entered into the system. Period. Lastly, a note on how to use the indicators we discussed. It is always better to treat these indicators as secondary confirmation tools. Your primary guide should remain price action. In other words, keep watching the market itself and ask a simple question on your chosen time frame. Is the price trending? Is it consolidating? Or is it mean reverting? The indicators should only help strengthen or weaken that view. They should not replace it. Another thing to remember is that the indicators that we discussed, range statistics, EMA-based trend states, and market breadth crossover signals, should be applied on spot to determine entry and exits. It can sometimes help mark the start and the end of a trend. Additionally, you can place a super trend-like indicator on options chart as a risk management tool, but your primary signal has to be from spot. Also, as a scalper, always keep an eye on the range because range gives you context and that matters. For instance, if the typical 5-day average range is around 300 points, but today the market is already done for 50 points, then you may want to be cautious about taking fresh breakout trades, especially in the afternoon setups. Similarly, if pullbacks are becoming unusually deep instead of staying within their normal structure, that is often again a sign of weakness or instability and something that you should factor into your decision making. The indicators I spoke about are only indicative and they can get noisy. And one of the best ways to improve your interpretation of them is to simply observe them over time. Watch how they behave as the market evolves and try to build a feel for what they are telling you. Even if you're not trading, you can make a mental exercise out of it. Ask yourself what the market is likely to do next, and then see whether your reading turns out to be right or wrong. That is a useful way to sharpen your judgment without immediately risking money. Of course, at some point, if you really want to learn about execution, you will also have to put real money at risk. Observation helps, but trading with real money and execution teaches its own lessons. Finally, to get better at understanding market behavior, it is very important to watch the market in the context of regimes. As I said earlier, we may be in a high range, high volatility environment right now, but that may not remain the case forever. One of the mistakes traders often make is getting anchored to the current regime and assuming that market behavior will stay the same forever. When the regime changes, say from high volatility to low volatility, the same setups may stop working as well, and that is when losses begin to appear without any obvious reason. Very often, the reason is simply that the market environment or the market structure has changed. Keeping regimes in mind will help you adapt faster and manage both future volatility and the absence of it much more effectively. Now, I know that was a heavy episode and you may need to rewatch it in parts to make better sense of it. Anyways, that brings me to the end of this part 5 on scalping. In the next and the last episode of Scalping, we will look at position sizing and psychology needed to survive scalping. I hope you found this episode useful and interesting. Do share your questions, thoughts, and feedback in the comments. I will do my best to respond. Thank you for watching and see you in the next one.